How's it going, fellow traders? It's Magic Trader here, and this is the CFTC report that was released October 31st. And here is a quick glance at the data that was released. So these are the positions of the hedge funds. And so let's take a look at gold and take a look at what the institutions have been doing with gold. Okay, so a couple weeks ago we reached a high of 284,000 long positions, right? And that was a couple weeks, so that would be down here, a high of 284 long. Price has since gone up and then retraced back to the origin of this weekly bullish engulf, but long positions are now at 678. Short positions have also closed out from 83,000 to 75,000. All right. So if shorts were increasing during this time where longs were decreasing, then I think that maybe we are going to get a drop down. But that's not happening. In fact, over this period, long exposure has only gone up 1 point, from 77% to 78%. Right? Looking at net positions, we used to be at 200,000, dropped down to 193,000, but still very positive. So, very bullish bias here on gold. All right? Long positions are 268,000, but very aggressive. Right? Not as aggressive as when we were here in September. All right? Not as aggressive as here, obviously, because we've since retraced, but still aggressive. Bottom line is, shorts are cooled off, longs are aggressive, 78% of their overall exposure is geared to the long side, and net positions are 193,000. So, I'm personally waiting for new long setups to take this one long. Targets will be up here at the weekly supply, because once that weekly supply gets hit, I think we're going to see a nice drop from there, and then new areas of demand to get in long again for me. But I am looking to get in long down here. There is a possibility that price can drop down to here. It all depends on what the US dollar does. Right now the US dollar is in a situation where there's really nice supply located just above price right now. So if price gaps up and just makes a quick rally into that area, it's going to drop, and it could potentially drop down to the weekly demand that's located lower. So my guess is that gold maintains this level here, and as the US dollar drops from that weekly supply, we see gold drop down to here. And when the US dollar drops towards that weekly demand zone, gold rallies up to this weekly supply. Then we get the reaction. The thing is that once US dollar gets to that weekly demand, what is it going to do next? That's the key question. But we'll take a look at the data when price eventually does get there. For now, what I see is gold longs are aggressive. It's very clear about that. Shorts are cooled off, and overall exposure 78%. Those are big numbers. So my bias is long. Extremely long when this weekly supply zone gets taken out. When that weekly supply zone gets taken out, the skies are clear for a larger rally upwards. Let's look at oil. What do we see with oil? We see that they are increasing their long exposure. They used to have 710,000 positions long. They increased to 734,000 positions long. And they dropped their shorts quite significantly. They used to be somewhat aggressive. Take a look here. Right? The coloration of the cells, somewhat aggressive. And that was up here. Right? These areas here. So they were somewhat aggressive, price retraced, and then boom, shot up. So with this long green candle here, what did they do? They closed out their shorts. Increased longs, close out the shorts. Increasing long exposure from 73% to 76%. And take a look at this. These are massive numbers. Okay. Net positions went from 446,000 to 502,000. You know what that means? They're extremely, extremely bullish on oil. But you know, then again, we've known this since price was all the way down here, right? Since price was here, we've known that they were going to get bullish, and then we saw the proof of it as price moved up, and then when they were accumulating more and more of their long positions. So right now we're just about ready to hit this weekly area of supply, where I will watch for a move down to this weekly area of demand, and then within this weekly area of demand I'm going to be adding or trying to get in long oil from here. This is going to be my area where I'm going to be looking for confirmation longs, because I'm not a huge fan of that weekly base. The candle formation is not great, so I'm going to be taking confirmation trades off there, or basically waiting for price to drop down, waiting for momentum to shift, and then taking long positions to the upside. So long is the way to go, but just not where it's at now, because we're just about to hit supply. Once price gets up here, I believe we're going to start to see that supply get put back into the market. Prices will drop, longs will close out for profit taking, and then prices will drop into that weekly demand, and then we'll see momentum shift and then head higher. Alright, so let's take a look here. US dollar, what do we see? They drop longs from 32,000 to 30,000, but they also drop shorts from 36,000 to 30,000, right? So long exposure is only 49% and short exposure is only 51%. So nothing telling here. We do know that they are short bias, simply because if you examine the data and you take a look at where they were back in April. Okay, back in April here, at these levels, they were extremely bullish, even though prices were dropping, right? Extremely bullish, but prices were dropping. So that doesn't mean that we should have gone long, right? Because they were extremely bullish. They're extremely bullish, but they needed to close off some of their longs to eventually get in short, which is what they've done here. So prices were dropping, they got in short, became a very bearish bias throughout these areas since June. Right here. Very bearish. Right? Long exposure was 56%. So if you just took a look here, you'd say, well, long exposure is 56%. Higher than short, so we should go long. Well, no. We didn't go long in June because prices were dropping in June. Right? The coloration of the cells were telling us, based on how they were positioned just not long ago, we should be considering them to be bearish bias, because 56% long is considered to be very bearish based on where they were just weeks ago. So it takes time for institutions to switch from one heavy bias to another heavy bias. So to get a better sense of what the institutions are doing, I've created a spreadsheet which shows me a specific coloration of the cells, taking into consideration the numbers of the positions that the institutions were holding just previously in the previous months. That way we get a good indication of what the institutions are feeling before the actual exposure numbers give us a clear indication of it. Okay, and like here was a clear indication here. Bearish, and that was this area here. And of course we got price to drop. So now we're retracing upwards. And if you look at the numbers here, you'll see 51 and 49. So if you were just looking at those numbers, you'd say, well, there's absolutely no bias right now, because 51% short, 49% long, they're pretty much 50-50. So there's no bias right now. Well, Not necessarily. There is you can't say that there's just no bias, because based on where they were just previously here, this is very bearish, these numbers, right? This is considered to be very bearish. So now, if we start to see these numbers climb, if we start to see these numbers get back into the 55s, 60s, then we'll start seeing neutral. Okay, it doesn't mean that they're taking price upwards. It's going to be more neutral. Because look, after a big drop like this, it's very possible that we get a big increase in longs to get back up here. It is possible. But long exposure would have to increase quite significantly to get up there. And then we'll see a bullish bias. But it's very easy for price to get up here and then drop back down. And that's why the coloration of the cells are still telling us they're bearish. Let's not get too excited and think that there's no bias here, because they are bearish. So that's how that works. I just wanted to point that out because I had a couple questions regarding these numbers and what that actually is telling us. Why do I consider this to be bearish even though it's 49 and 50, or 51? So that's the explanation for that. Alright, so let's get on to Aussie. 85,000 positions long versus 33,000 positions short. So what do? They increased shorts by about 5K, and they left longs alone, and that came with this big drop. So a big drop into weekly demand. So they increased shorts to get price down here, but they left longs alone. Now, if the institutions wanted to drop price down here to test this monthly area of demand once again, what we would be seeing is longs closing out and shorts increasing. So we got the shorts increasing portion here, but longs are not closing out, they're holding, right? Especially with this big candle here. So the reason why I believe longs are not closing out is because they're planning on taking it long within this area. All right. So shorts were needed to get price to drop into weekly demand. Longs are holding because they want to start accumulating longs within here. So why are they going to be closing off longs if they want to start accumulating them, right? So so that's what I think is going to happen. We got an upward trend line here on the monthly, and we got this really nice area of weekly demand with the weekly uptrend. I believe they're going to start accumulating here, and I think we're going to start to see it on the next couple reports. All right, next week's report will tell us what's happening with this candle, and as we can see, consolidation here happening within this weekly area of demand. So I think what we'll most likely see is longs increasing and shorts decreasing. That's what I think we'll end up seeing, but we'll wait for that to happen. So long exposure dropped 3 points, but we're still bullish biased. Net positions positive 51,000. Okay. Slight decrease from the numbers, 70, 60, 51, but we're still long biased. Okay. We should be expecting that decrease because price did retrace downwards from a weekly supply zone. Okay, so let's take a look at the US CAD. So US CAD longs increased by 2K, shorts decreased from 96,000 to 84,000. That happens as we had this nice green candle here, straight into this area of weekly supply. Right. So longs increased by 2K, but still remained very cooled off, considering previous positions long. Very cooled off. Shorts remain aggressive, considering previous short positions. Short exposure dropped 4 points, but still remain at 76% of their overall exposures to the short side. So a couple things can happen here. The chart technicals really tell us that there's a very good chance price rallies up here to this weekly area, or this monthly area of supply. Okay, there's a big chance of that happening. But we also are testing a monthly 20 EMA in a monthly downtrend. So price can stall here and head down. That would make complete sense considering that shorts are still very aggressive and longs are cooled off. Now, if price was to get from here to here, then what I would be wanting to see is longs becoming aggressive. You know, getting out of cooled off territories and getting aggressive, because otherwise they're going to be losing out on these shorts. Now, if it's not that much of a rally up, then there's times they'll let their shorts get into a drawdown until the eventual reversal happens. I've seen that a lot, where they'll just let it get into a drawdown if there's not that much of a room up. But if there is a lot of room upwards, they're going to hedge. They're going to add longs so that they eventually, when price does lose momentum and shift, they close off their longs for profits. And then it's as if all these shorts that they added here or here, all those shorts that they added are at a better price. They get them at a better price, because if you add shorts here, when it moves between here and here, you're losing money. But if you're adding longs between here and here, those longs make money, so it counterbalances the loss on the shorts. So when you close off those longs up here, it's as if you're taking those short positions here, up here, and then you profit from those short positions on the way down. So that's what the institutions do a lot of the times. Most of the times, actually, from what I've witnessed. Alright, so very good chance that we stall out here and then we see price drop. Okay, we are within a 3-month demand zone, which got tested deeper, very deep here. So we could see a deeper penetration and breakthrough. That's a possibility. But what I'm focusing on is the fact that the institutions are short biased. Okay, coloration of the cells, red. Negative numbers here, they're short biased, period. Nothing else to see here. No trades, no setups. I'd have to wait and see for new daily supply zones to be formed and some really strong supply to come into the charts for me to want to take any short positions here. Okay, US Swiss franc, here's the one that caused the shift, the momentum shift in all the US pairs, is when US Swiss franc hit this monthly area of demand. So if you look at the US dollar, you look at the US CAD, you look at all those pairs, it looks like they just turned on nothing. There was no demand zones for the US dollar to reverse itself. It just reversed on nothing. Well, if you take a look at the US Swiss franc, you'll realize that that turn was not based on nothing, but actually based on this really nice area of monthly demand here. So now we're sitting within a monthly supply zone right here. So I'm waiting for momentum to shift and then a move to the downside like this, okay, which supports the argument of the US dollar not rallying much more than the weekly supply that's just above it. And once it hits that weekly supply just above it, the move to the downside is what is to be expected, okay? So that's what I am watching for. Euro US dollar. So institutions dropped their long exposure from 183 to 173, and they left their shorts pretty much alone. Okay. So this happened as price dropped from the weekly supply area here. So price drops from a weekly supply zone, they close off their longs, and they leave shorts alone. Now, why are they leaving shorts alone? Why are they not adding shorts when a weekly supply zone is being touched and reacted from? Right. So if I was expecting a price drop down here to the monthly demand zone, I'd be expecting for shorts to be increasing quite dramatically at these areas here. Weekly supply, fill in shorts for the move downwards. Yeah, we see an increase from 96 to 100, and then this last week from 100 to 101. I mean, that's it. Short exposure rallies from 35% to 37. Nothing big. Net positions from 83,000 to 72,000. A slight drop in net positions, but nothing huge, right? Short positions are still cooled off. Long positions are still aggressive. Now, take a look. Short positions are also below their average price of, or position size of 104. Longs are below their average of 190, but that would be expected since we are retracing downwards, right? So, what's to come then? There's a chance that price drops all the way down here. There's a chance. And what we would want to see over the next coming weeks is shorts being added to aggressively and longs being closed out. For a big drop like this, I don't think they want to be holding longs here. If they added longs here, they'd want to be taking profits here, so they'd want them to be closed off. And what we do know is that last time price was here, they added 5,000 positions long, and the last time price was here, they added 15,000 positions long. Okay. And that was back in, what, April, May, June? There. And June. Alright. So they'd want to be closing off longs and adding shorts. Yeah, we see a slight decrease in longs, nothing big, still aggressive. And shorts not being added to aggressively. So nothing really here is telling me, by looking at the data, that they're preparing for a big drop here. Okay, it's just not telling me that. Okay. And also when you look at gold, remember gold is sitting within a nice area of demand, right? So it just wants to go up. So can you see the euro dropping all the way down here if gold is going to be going up? Not really, right? So there's a few things that make me believe that this is not going to happen, this drop. At this point. Things can change, but at this point, from looking at the data, this is what I see happening. Something like that. That's what I see. But could be wrong. Could easily drop. So we'll see. Alright, so pound US dollar. We got a really nice area of weekly demand right below. Why do I love this area of weekly demand? Because it accomplished something on a higher time frame. And what I've come to learn is whenever something on one time frame accomplishes something on a higher time frame, that something on that lower time frame is always very important. This weekly area of demand was responsible for removing a trend line here, a monthly trend line, which comes right across here. This area, nice explosive move to the upside, breaks the monthly trend line, and now price is retracing back to it. So I'd like to take longs there. Okay. I'd like to take longs here. So long exposure drops by 1,000. Shorts drop by 3,000. And again, right? 50-50. So institutions are 50-50. So at first glance, you take a look at this and you're like, well, there's really no bias here because it's 50-50. Yes, it's 50-50, but you know, considering where we were, this is very bullish. Okay, considering where we were, because again, it takes a while for them to shift from one heavy bias to another. We've got 3-month area of demand in control. That means institutions are accumulating a long position. It takes time to do that. So 50-50 is not neutral. They're in the process of switching from bearish to bullish. From 19% of their overall exposure being long to 40 to 30 to 40 to 30 to 47, 57, 50, 50. It's a bullish move. Very bullish move. Okay? So right now I'm expecting longs from down here. I'm waiting for price to drop into that area, and then I'll be taking longs. I'm going to open up my first basket of long positions straight off of the weekly zone, and then I'm going to be waiting for momentum to shift and start reversing to the upside, and then I'll be looking for long positions to add to my first basket of longs. Alright, let's go to the next one. We got the US dollar Japanese yen. This one's been a very tricky chart. So let's take a look at what we see here. Institutions dropped their long exposure by about 3K, from 176,000 to 173,000. But they also dropped their shorts from 60,000 to 54,000. Long exposure in the process increases 1 point. And net positions increase by 2,000 as we consolidate. So price is consolidating within a twice tested weekly supply area, and as that happens, long exposure increases by 1%. Okay, longs are aggressive. Shorts a little bit aggressive, but nothing crazy. Net positions are positive. So there is a bullish bias here. What I'm watching for is there's a nested area of daily supply within the top quadrant of this weekly supply area here. I believe if price rallies up into that area, it may be timed with the US dollar rallying up into the weekly supply. And once we get a drop from that area on the US dollar, I think we're going to get a reaction from that area to the downside here. That's what I am just thinking. Or we could just basically break up and head higher. There is a possibility of that happening since we're so bullish biased. So just watching to see how price is going to react from that nested daily supply zone first. If that nested daily supply zone breaks, then there's clear skies for it to move higher, because there'll be nothing else to hold price downwards. The Kiwi. Longs are cooled off. Shorts are now starting to become aggressive. Right? We got 3-month area of supply and control. Price created a weekly confirmation trade, dropping, retrace, now dropping. We're just about to break through a weekly area of demand. I had a monthly very questionable area of demand here, but then I removed it because it was too much in question. So if it's so much in question, then it shouldn't exist. So there was no demand here. There is on the weekly, but not on the monthly. So therefore, nothing to stop price from dropping. If price drops just a little bit further, we'll have a nice area of monthly supply, which eventually can be used for a further move to the downside. So how is this going to play out with the potential weakness in the US dollar? That's the real question here, because typically if we see the US dollar getting weaker, we'd expect the Kiwi to get stronger, right? So it'll be a learning lesson for me to see exactly how the Kiwi reacts and learn from it. That is just to say, that is only if the US dollar does get weaker, and we don't know if that's what's going to happen. There's a higher probability that's what happens, but we don't know that for sure. Alrighty, so that's pretty much it. On Monday, we have the Aussie rate release coming out. So interest rates for the Aussie on Monday. And then the Kiwi for this pair, we're going to get the interest rates coming out on Wednesday. So those are those two areas, those 2 points that are going to cause some volatility in the markets this week. And that's pretty much all I want to relay to you guys. So hope you enjoyed this video, and be safe out there.